Okay everyone, welcome to the Millionaire Incorporated Forex Basics trading course. We're going to go into module 1 on Forex Basics. So what we're going to cover in this is the difference between investing versus trading, what is Forex, trading basics like long versus short, Forex basics, what's a pip, what's a lot, and leverage. So let's jump into it. So some of you may already be familiar with currency trading or have at least heard about Forex. So we're going to go over and cover what it is and how it can be a great skill that you can learn to earn real money and lead to a life of financial freedom. But don't think that once you've finished this tutorial course that you'll be a master at trading. It still takes a lot of practice and learning until you can actually become consistent enough to be a profitable trader. But I have also got you covered in that area at the end. So we'll get started. So there is a lot of information out there about when it comes to trading and Forex, some useful and some not. So during this course, I'm going to go over some of the basics to do with Forex trading, what it is, what you need to know about trading, and some of the basics about charting and how to understand a chart. Multiple time frame analysis, picking your trading style, opening an account, and then to wrap it up, I'll actually go over my strategy for how I trade and what I look for trades. So first of all, you have to understand that currency trading is not investing, and there is a distinct difference between investing and trading. Investing takes a long-term approach and view into putting your money into a vehicle for a financial gain. Now this is a more common thing for things like stocks and shares, houses, bonds, term deposits, and businesses and things like that. Because investing takes a view that it's less risky and you're putting your money to work for you passively, so you have a very kind of hands-off approach to it. Trading, on the other hand, makes profit from movements in price of an instrument over a short period of time, and you have a much more involved role in how it all fluctuates and moves, or when you're entering a market or buying an instrument and selling it. So most people understand investing in stocks and the basics principle of it. You buy low, sell high. Similar thing with property, but this is not the case for Forex. And even for me, it took a little bit of time to wrap my head around the entire concept, because Forex moves up and down all the time, and you can actually make money as it moves down as well as when it moves up. So first of all, Forex stands for foreign exchange. And Forex trading is the selling or buying of one currency against another for profit. That's what it is in simplest terms, and it's actually the largest currency market in the world, with roughly $5 trillion traded every single day. And that, if you think about it, that's a huge number. It's traded by institutional investors such as big banks and firms and large corporations, all the way down to your retail investors or traders, or which is commonly you and me, or at home mum and dad's kind of thing. And you may not think about that you take part in this kind of trade, but if you think about it more closely, when you visit another country and you need to change your money from your local currency into the currency of that country which you're visiting, that is in effect an exchange of currency, or foreign exchange trade. And another example of this is when you're buying items online from another country. So most transactions online take place in US dollars, but you may be living in the UK, for example, and obviously there you use the British pound. So this means that the money has to change from the pound which you use into US dollars for that to take place. But don't worry, because with the internet, this actually happens seamlessly and simultaneously without you even having to worry. You probably just noticed that afterwards on your transaction, on your bank statement though, that the transaction took place and it's not quite the same as what you saw on the screen. So it might be, say, 50 USD, but you're living in the UK, so it's probably going to end up being like 35, 40 bucks or something like that. When you're trading currencies though, and trading purely for profit, you're essentially taking a bet that the economy of one country is strengthening against another country. And the Forex market is traded 24 hours a day from Monday to Friday. And currencies for the respective country are represented as a 3-letter code which correlates to the country of origin and the name of that currency. So the most common pairs that are traded on the Forex market are the US dollar, which is the USD, the Euro, the EUR, the British pound, GBP, the Swiss franc, CHF, also commonly known as the Chief, the Australian dollar, the AUD, the Canadian dollar, the CAD, and the New Zealand dollar, NZD, and the Japanese yen. These make up the major currencies on the Forex market, and a Forex pair is written down as a 6-letter symbol. So that's the first 3 letters of the base currency, and the second lot of 3 letters are the currency it's trading against. So example, Euro USD is the euro traded against the US dollar. From here, pairs can be further grouped into majors, minors, and exotics Forex pairs. The Forex majors constitute the largest share of the foreign exchange market at about 85%, and therefore they exhibit the highest market liquidity. And these majors are the Euro US dollar Japanese yen, the British pound US dollar, the Aussie US dollar, the US dollar Swiss, the New Zealand US dollar, and the US dollar CAD. As you can see, all of these pairs are a combination of the US dollar traded against one of the other major currencies. And this is because the US economy is the largest in the world, and the majority of global transactions are in US dollar. From here, all other combinations of the above major currencies are considered minor pairs. But currency pairs aren't just limited to the combination of these currencies listed here. Every country in the world has its own currency, and the exchange of one currency for the other is or can be considered as a pair. Unfortunately, these don't have the same level of liquidity and tend to be a lot more volatile. These combinations are also called exotics, and for the beginner and even some intermediate traders, I would strongly advise against trading these ones. So Forex is a bilateral trade. So this means that the currencies are always traded in pairs. So you'll always be buying or selling one currency against another. An example of this is if you think of the US economy is going to get stronger and the euro is going to get weaker over time, that you're going to sell the euro to buy the US dollar. And over time, if you're right and the US dollar does increase in value or euro decreases, eventually when you don't think it has any further to go, you go and buy the euro back, selling the US dollar for the euro. So in the Forex market, you would take a short on the Euro USD, so the euro against the US dollar. And the price of a currency pair is represented as a ratio of one currency for the other. So for example, the Euro USD is the amount of US dollar you'd get for 1 euro, and it may look like 1.1101 or whatever the current value is. So if you are changing 1 euro for US dollar, you're going to get $1.1101 US dollars for that 1 euro. And a way of thinking about this is like exchanging money for a loaf of bread. So for example, one loaf of bread might cost $1.30 USD, and different brands have different prices, and over time, due to inflation, that price of bread goes up. But in trading, you're looking at capitalizing on the change in the price as people exchange more of one currency for another, and the price of the pair moves accordingly. So what does it mean to go long or short, you might be asking yourself now? Basically, a long trade or long position means that you're buying one of the currencies, and it can also mean that you're bullish on the currency or currency pair. While short means that you're selling one of the currencies, and can also be referred to as being bearish on that pair. So buy or long or bullish means that the pair is going to go up, and short or selling or bearish means it's going to go down. But because currency pairs are always traded in pairs, this means you are simultaneously taking a long and short trade at the same time. So take our above example of shorting the Euro USD. In this trade, you are short or selling the euro and simultaneously long or buying the US dollar. The next thing you need to know is how we measure price movement in currencies. So we all know, or possibly know, that when we buy a stock of a company, we are buying part of that company at a fixed price in our currency at home. So if you live in the UK, you're buying it in pounds, in the US dollars, and Australia, Aussie dollars. So say you buy $100 worth of stock in company ABC at $1 a share, you will have 100 shares of company ABC. Your profit or loss is measured as its price moves away from the price you initially bought it at. So if the stock price goes up to $1.10 a share, you've made 10 cents a share, or a total of $10. So 100 shares at 10 cent change in stock price, which is 10 bucks. So typically the price change is measured in cents for stocks, sometimes dollars. But what are we measuring when it comes to Forex? If you tune into the news at night, you probably are seeing your local currency and what you can buy other currencies for around the world. But you note that they are probably recorded as about 5 numbers, and the change from one night to the next is usually a lot less than a cent move. So the change we normally typically notice is the third or fourth digit or number being different. So how do we record a change in the price of a currency pair? We record it as a pip move, or a price in point, and it's typically the fourth number after the decimal place. Or in the case of the Japanese yen pairs, it's the second number after the decimal point. In the example of Euro USD above, the fourth digit after the decimal place is a 1, and we record a pip move as the price moves away from that point. So if you are buying the Euro USD at a price of 1.1101, a 1 pip move would mean that the price has moved from that 1.1101 to 1.1102. But when making a trade in the world of Forex, you can't just buy 100 shares of a currency pair, because it's not a company and isn't traded like a company. So Forex pairs aren't broken up into a finite number of shares being traded on an exchange. In Forex, what it can be seen as doing is placing a trade exchanging lots of $100,000 of one currency for another currency. So when you're trading Forex, what you do is trade currency pairs in units of $100,000. And that $100,000 unit is called a standard lot. And a change in ratio between one currency against the other is measured in pips. So what this means is if you're buying a pair, let's take the Euro US dollar example again, at a price of 1.1105, and you're doing a one standard lot trade, you're trading 100,000 euros for 111,050 US dollars. Now you're probably thinking, I don't have 100 grand to trade to start off with. How the hell can anyone be doing this? How do some people do this regularly and post about it online? None of my friends have that kind of money. So don't worry, nor do I, and neither do a lot of people out there. Now we do not recommend trading a standard lot straight away, but you can trade with what are called mini and micro lots. And this is called a 0.1 lot or a 0.01 lot. And this makes it a lot easier to get into trading, as you won't need as much money to start. But even going off these metrics, for a micro lot, which is a 0.01 lot, you'll still need at least $1,000 to start, and still a lot of people might feel uneasy about doing this, because a total of 1 pip move will only mean a $10 profit if you risk your entire $1,000 on a single trade. Fortunately though, or unfortunately, Forex is typically a leveraged product. So the leverage means that you have a multiplier on your money and allows you to trade with more money than you actually have. So say you have a 2 times leverage, that means you have twice as much money at your disposal to use. Typically with Forex though, you have a much higher rate of leverage available to you. So when you open an account with a Forex broker, you're gaining leverage on your money. And typical leverages for Forex are 100, 200, or even 500 times. But in America, I believe they have capped that at a much lower rate, and there's news about in Australia that they're going to reduce the amount of leverage allowable to maximum of 20 times. So if you open an account with $200 and you have $500 times leverage, you effectively have $100,000 to trade with. So using leverage can be a great tool to make money without having a lot of money, as smaller moves in price means you can make a lot more money a lot more easily. But leverage is a double-edged sword. So while you have the ability to make large amounts of money faster, you also have the exact same opportunity to lose that money just as fast. So you have to take extreme caution and use risk management when trading. And we only advise using money that you are comfortable losing when trading. And this goes with any kind of investment. Don't use money you need for food, rent, or important bills. Create a budget and make sure your living expenses are taken care of first at all times. Risk management is a completely separate topic on its own, and I'll actually go through that in a much later stage.